It is 2 p.m. in New York. It is 7 p.m. in London. Live from Bloomberg's World Headquarters, this is Bloomberg Markets The Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Taylor Riggs.
And optimism, it sweeps through the market. Stocks surge, the dollar falls as the U.S. population eyes a new political landscape. Is this risk-on mood vindicated? We guide you through the last few hours of trade. And it is here, finally, Election Day. Over 100 million Americans have already cast their ballots early this year, about 3/4 of the entire turnout of 2016. We get the latest from President Trump and Joe Biden's campaigns this hour. Meanwhile, Jack Ma's $35 billion IPO on hold. China halting Ant's much-anticipated public debut, shocking investors who lined up for a piece of what was expected to be the world's biggest initial public offering. Why China has upended one of its biggest business success stories. All that and so much more. Romaine.
Yeah, on any other day, that would be the biggest story of the day. But of course, the biggest story on the day here in the U.S. and really globally is what's going to happen with the deadline here for balloting in the U.S. elections. You can see the S&P 500 risk-on sentiment pretty much across the board. Not only what you're seeing in equities, but you're seeing that reflation trade really carried out across the board in the commodities space. You're seeing dollar weakness here on this day and a little bit of a sell-off here in treasuries, particularly on the longer end of the curve, giving you a little bit of steepening there. A lot of bets here, I guess, on the outcome of this election seem to have been solidified here, Caroline and Taylor. What direction those bets are, I guess we're going to find out maybe in about 24 hours' time.
We might. Let's take a look at some of the direction of the equity markets. Take a look at this chart that we're showing inside the terminal. It's all about growth to value, right? Well, here's the problem. Value relative to growth still near a record low, even though you try to get some of that cyclical rotation today. Not quite enough to dig us out of this deep hole, but that is something that we are watching. What's driving that? What's underlying that? Moves in the 10-year yield. Caroline, we're now up to 88 basis points. We're now the highest 10-year yield that you've had since June. This is really underlying some of that reflation trade underway.
Many betting of this so-called blue wave. Is that what's being priced into the market? Let's dig deeper. Let's bring in a rather legendary bond fund manager. Dan Fuss is with us. Loomis Sayles, Vice Chairman. Always great to have your day. On such a day, Dan, are you buying this risk-on mood?
It's too early. It's too early to say that. Right now, there were people lightening up on their positions very early on the high yield side. That seems to be over. Stocks are doing well. Bonds are not, although they're coming back a bit for the Treasury market. And as you pointed out, currencies are weak. But that's not the issue. The issue is that for the last few weeks, notably absent from doing anything dramatic, has been the Fed. It's elections, and they traditionally step aside. And now this time they didn't step completely aside, but they've been quiet. We're in a period, in my opinion, loosely analogous in one respect only to the 1940s through the early 50s of war finance setting. In other words, we've got to spend the money to get out of the hole. You can analogize the coronavirus impact with that.
Yeah.
And that took a cooperation formally called an accord between the Fed and the Treasury. I doubt if we'll have a formal accord, but there's an implied support coming from the central bank because the Treasury's got to raise a lot of money to pay the bills.
Yeah, I am curious, Dan, on that. I mean, because the market seems to be betting that to a certain extent we are going to get an additional bout of fiscal stimulus that will justify some of the valuations, some of the trades being made. But we are going to get that refunding announcement from the Treasury, I believe, tomorrow. We're going to get a better sense of longer term, based on the outcome of the election, what type of fiscal policy we're going to have and how much Treasury support is going to be needed. Is the market maybe getting a little bit too far ahead of itself with this reflation trade without necessarily knowing what the Treasury is going to be on the hook for?
Well, I agree with what you just said, but it's clear that Treasury is going to be on the hook for a fair amount of money. The question is how much? And then you go back and you look at, say, well, okay, we're going to raise taxes, et cetera. That's going to provide some money. Is it going to provide enough? No way. If you take the taxes too high, then you discourage the economy from another view. So this is in my Navy days, what they called an all hands on deck. You know, in other words, everybody get to your stations because we've got to deal with this. Now,
I am curious, when do the bond markets start to wake up and pay attention to some of these deficits that you allude to?
Oh, jeepers, what was it, 3 months ago, 4 months ago? You know, about the end of May, early June, somewhere in there, you started to see it in treasuries. You did not see it in high yield. In between, you have investment grade. And you started to see it, but not as much as treasuries. That's an oversimplification, but that was essentially it. The liquidity support to the bond market has been phenomenal. Even with the the Fed sort of hanging back, the assumption is they are there, and I think that's accurate.
Dan, let's talk about the Fed a little bit more because, of course, we do get a meeting on Thursday amid all of this election excitement. Not much expected, but what do you think the relationship going forward with the Federal Reserve, with Jay Powell and potentially the administration could look like in the future? Is there anything that might change the current environment in which we sit with how and when the Fed might raise rates?
Yeah, oh, wow. That's a $10 million question. There are lots of things that could change. Appointments, obviously, to the board. Right now, my own view of the Fed is I think they're a very common sense group of people. And, you know, they're in tune with the market far, far more than any of us, I think, through the Fed in New York. Within the Fed, they undoubtedly will have some sort of political dispersion, but they're a responsible group, and they see their view. They can't increase taxes or spending. That's not their job. Their job is to keep the markets functioning well to the degree they can. And some people will argue with me and they'll say, well, that's all well and good, Dan, but you know what? There's only so much the Fed can do. I agree with that. But they have a multiplier effect on their actions. The next argument is, well, that multiplier is less. Yes, it is. But it is still a multiplier. So if you ever sense that, well, they're not going to help support, then get out of the way because Treasury's going to have a terrible time.
Yeah. When you talk about that multiplier effect, Dan, I mean, I think everyone would sort of agree that the Fed, to a large extent, did its job as prescribed earlier this year when the pandemic really started to affect financial markets. There's a sense, though, that going forward with rates pretty much at zero and with only, I guess, a few more tools left in the toolbox, which would presumably be some type of bond buying, that there's only so much more the Fed can do.
Well, Romaine, that's accurate, but the only so much more is actually quite a bit. And, you know, they could, I doubt if they ever would, but they could decide, okay, we're going to drive rates down to zero. That's counterproductive, maybe not for the bond market, but for other things. You want to keep the economy, you know, foremost in your mind at the same time you're watching the markets. The two go together. If the market collapses, bad for the economy. An up market doesn't guarantee a good economy, but it's certainly a stable market helps a lot. And interest rates staying low, in theory, should help some types of investment. And now that theory has to be tested here. But what they want is stability. And no matter who wins on the election and what the composition of the legislature is, you hope, now hope's not a strategy, but you hope that the number one thing is to, okay, let's get some sort of balance in the world here, and let's get our economy better by making ourselves healthier. You know, I don't want to give a political speech here, but I do hope and pray that we can be healthy. If we're healthy, we can, you know, we can deal with this.
Yeah. All right, well, today, Dan, of course, it's going to be a big day, obviously, for our nation and for what it means for policy. Of course, a big day for markets as well. Dan, you've obviously had a front row seat to quite a few elections, quite a few market cycles, and we really appreciate you coming on here on this day to talk to us. Of course, that's Dan Fuss, of course, Hall of Fame bond investor there, Vice Chairman over at Loomis Sayles. All right, coming up next here on the program, of course, that day we've all been waiting for. It's here. We're going to give you the view from the headquarters of both campaigns as millions of Americans cast their final ballots, plus a $35 billion suspension. Why China stopped the listing of Jack Ma's Ant Group when it was expected to be the world's biggest IPO. And do you have plans for election night? Well, we talked to several tech CEOs, and we're going to let you know what they're doing tonight. It might not be what you think. All that and more coming up next. This is Bloomberg.
It is election day, and one thing we're doing for our Bloomberg audience, of course, focusing on the markets and then the impact on the elections as well. One way that we've done this is take a look at some of these low tax stocks, which you guys have been really correlated pretty well with Biden's polling. As his polling has picked up, some of these low tax stocks have been outperforming the high tax stocks, of course, on expected higher taxes that may eventually come. Joining us now from the Biden camp in Wilmington, Delaware, it is Bloomberg's Emily Wilkins. Emily, what are you focused on? What is his message in the final day?
Well, Biden today has currently been in Pennsylvania. He was in Scranton this morning. He's now in Philadelphia. And, you know, for an election that has been really defined a lot by the coronavirus, Biden is going right back to his initial message that we heard in 2019, that the nation has been divided under President Donald Trump and that a Biden presidency will bring the nation back together. That has been Biden's main closing message. We expect him at this stage behind us later tonight to address the nation, whether or not we know at that point who the next president will be.
Is there a general sense, though, there within the campaign, Emily, that there won't necessarily be anything to address tonight?
That's absolutely a possibility, that we're not going to know who the president is. We're not going to know who controls the Senate. But I will say there are some states where, you know, they are good at processing absentee ballots. They are swing states. I'm thinking Florida, potentially, North Carolina, potentially Georgia. And so we might start to get a sense tonight how things shape out. Another thing we've heard from the Biden campaign a lot is sort of urging voters to be patient, to have the ballots counted, and to sort of preempt any sort of early message from the Trump campaign that Trump has won before anything can be official.
Emily, how's everyone feeling on the ground?
I think there's sort of a mix between confidence because they have been leading in the polls for so long, particularly in a number of swing states, but also caution. Democrats do not want to repeat the mistake of 2016 of thinking that they had it in the bag only for Trump to pull out a surprise victory. So I think there's definitely sort of that mix of hope and yet cautiousness there. They've particularly focused in the last couple of days on turning out Black and Hispanic voters because they've seen so far that they haven't been turning out to early vote and absentee vote in very large numbers. We could see that change today depending on who shows up at the polls in person.
What is the swing state that he needs? I think Pennsylvania is really what this point. I think Joe Biden and even Donald Trump would tell you how key Pennsylvania is for the both of them. I mean, this is a state that consistently went for Democrats year after year after year. And then in 2016, Trump won it by the thinnest of margins. Joe Biden has connections in Pennsylvania. He's been campaigning there a lot throughout this past week, throughout his entire campaign. But Trump has been there as well. He's been holding his typical rallies. So both of them have a really strong focus on Pennsylvania. Polls have narrowed there in recent days. And at this point, it could go to either campaign.
There he is out in Scranton earlier. We thank you. Emily Wilkins, live. Keep warm, stay well, and we're pleased that you're out there for us. And do stay tuned for all of our special election coverage. It is starting right here, 7 p.m. Eastern. You do not want to miss it. But coming up, first and foremost, we've got Alibaba shares dropping after Ant Group suspended its much-anticipated public listing in Shanghai and Hong Kong. We'll discuss this really quite phenomenal story. Stay tuned. This is Bloomberg.
If it weren't election day, this would be the story of the day. It is all about Ant Financial's $35 billion IPO, or at least was supposed to be. We do, of course, now want to take a look at shares of Alibaba because those ADRs off 8% in today's trading because, of course, they own about 1/3 of Ant Group. All we know so far, China has suspended both the Shanghai and the Hong Kong IPOs. For more, I want to bring in Sam Mahmoodi here, who covers our China finance coverage for us at Bloomberg. Sam, give us any other details. What exactly have we learned? What other information do you know about what happened between Jack Ma and then, of course, the Chinese government?
Hello there. As you said, this is a very big shock. And the Chinese regulator on Tuesday evening their time when they announced it, it was a very vague wording. It just said that some conditions had changed. They didn't give much details. We have a story on the terminal reporting from people familiar that they may have to increase the capital that they hold at their micro-lending units. That's really what's powered Ant over the years, especially in recent years. And they definitely have an advantage over China's bigger banks, so that may have been part of it.
I mean, Sam, should we have seen this coming? It felt as though Jack Ma had been out there, of course, somewhat criticizing local banks, global regulators in particular. I mean, calling in particular sort of the Swiss regulator sort of old in some way. But what about whether or not we should have expected this sort of fierce clampback by China? Why on earth suppress such a big business success story?
That's a very good question. Yes, as you say, he has been somewhat vocal in public, talking about essentially really the point he's been trying to make is that China should be more financially dynamic and have a financial system that reflects some of the dynamism in the economy. Why they did it today of all days, just, our understanding was that there would be an IPO on Thursday. It is quite unprecedented. He was called in to have a meeting with the top regulators on Monday, himself and some of, I believe, the Ant's top leadership. And that was assumed to possibly be a bit of a, kind of keep your house in order sort of chat. But whatever it was, it possibly wasn't strong enough, and they sent an even stronger message now.
So with the new sort of metrics that Ant Group would actually have to meet with regards to the amount of loans or the percentage of loans on its balance sheet, Sam, how attainable is that for Ant Group? And is this something that they have to do at this point, even if they opt not to go forward with the IPO?
We don't know exactly what the limits will be. Our colleague, Shuli Ren on Bloomberg Opinion reported earlier today that in China, the banks normally keep about 30% on their balance sheet compared to 2% for Ant, and Ant may have to go up to the 30%. That would obviously be a very, very big hit to its ability to make money. In terms of the IPO, again, it's all very early. It's overnight right now in that part of the world. But I think we'd be very surprised to see the IPO happen this year now. And obviously, this was something that had enormous investor interest. It was going to be the biggest IPO in the history of financial markets. And it's definitely on the shelf now.
Yeah, it was set up to be the world's biggest IPO for China's richest man, I should say, now on ice at the moment. Bloomberg Sam Mahmoodi there giving us the fill-in here on everything going on. Taylor, coming up now with the Business Flash headlines.
Yeah, let's get right to it. Want to start here with SAP, their CEO trying to put a positive spin on the company's slowing revenue growth. Christian Klein tells Bloomberg TV that more clients are transitioning to cloud computing products. The German software giant lost a third of its value following a forecast that alarmed investors. In England, JP Morgan has joined rivals in asking the vast majority of its employees to work from home. The government has imposed another lockdown to try to stop the spread of the coronavirus. JP Morgan has about 19,000 workers in the UK, about 12,000 of them in London. And a board committee at Twitter has concluded that CEO Jack Dorsey should stay in the job. The panel was asked to review Twitter's leadership as part of an agreement with activist investor, Elliott Management, and private equity firm Silver Lake. Both took stakes in Twitter earlier this year. Speaking of a tech CEO, there are a few others, of course, Romaine, planning to just hang out tonight on Election Day. I think one of my favorites was the CEO of Expensify, who said, I'm just going to work like another average day. I think sort of that's exactly what I'm planning to do, too.
I think the best thing about this story is somebody sort of knocked on every door and found Adam Neumann
Yeah.
of WeWork and got his response to this. To say that he's been keeping a low profile would be an understatement, but his spokesman basically said he'll probably be spending the day flipping between MSNBC, CNN, and Fox. He did not mention Bloomberg News.
They should tune in from 7 p.m. here,
I
of
knew there
course.
was a reason I didn't like
Our
it.
hardworking producers on this show are going to be up all night with that as well. Well, if Adam Newman's not going to be watching it, we're going to be bringing you the latest market reaction. Dow Jones up 1.8%. We're chuckling here. Russell 2000, the outperformer. This is Bloomberg.
This is Bloomberg Markets to Close. I'm Romaine Bostick.
I'm Caroline Hyde.
And I'm Taylor Riggs.
A little bit after 2:30 here in New York. Let's get you caught up on what's been happening here in the commodities space. Oil settling here in New York. NYMEX crude now up strongly on the day. Second straight day of gains here. This, of course, on that news that OPEC Plus may delay those planned output increase. But keep in mind, even with this two-day run of about 5% or so, we're still about 40% below where we were about 10 months ago, at about 10% where we were just simply 2 weeks ago. Seeing a little bit of a bid into gasoline here. Copper futures also getting a bid on optimism about the global economic recovery. And gold getting a decent bid here. Interesting move in gold as it hovers right around $1,900 an ounce ahead of the U.S. election.
Well, Romaine, you mentioned the election.
I
You
had
can't
to.
avoid it. From one campaign to another, let's bring in Bloomberg's Mario Parker, who's, of course, covering the Trump campaign. We just covered the Biden campaign. So, Mario, bring us the Trump perspective. What really is the camp saying today? What is their priority list looking like?
Well, we just heard the president about an hour ago speaking to staffers at his campaign headquarters in Virginia. The president's message was very upbeat. It was a morale booster. It was optimistic. He said he's confident about his chances for later on this evening. But he also took the time, of course, to deride some of the mail-in voting and some of the results in terms of vote counting that he's been doing for the better part of this election cycle.
Exactly. The continued sort of negative focus on basically the authenticity of the vote continues, Mario. How much is that resonating at the moment? How much will that be pulled on as a lever, do you think? And at what exact point might that ramp up?
Well, it's definitely resonating with his base. His base has bought that argument. And, of course, the party has as well. The president has kind of pantomimed that you'll see some legal challenges, and he's not going to really let anything that he thinks is maybe negative to get away. He's been really focusing in on Pennsylvania, for example, and really kind of signaling that could be a legal fight that he's raring to have.
And Mario, what's the plan for tonight for the president? Any plans to address the nation that we know about?
As of right now, we don't know of any plans to address the nation. We do know that the president will be watching the results of the election from the White House. They're having an event in the East Room. And so we'll see whether or not the president addresses the nation as the results start coming in.
All right, so President Trump will be in Washington tonight. Our very own Mario Parker will be tracking him, of course, as we await the results of the U.S. presidential election. Now, joining us to discuss some of the broader issues going on out there in the economy and the job market, we want to bring in Stephen Preston. He's president and CEO of Goodwill Industries International. He previously served as secretary of the Housing and Urban Development Department, as well as running the Small Business Administration here in the U.S. So he has a pretty unique perspective about what's going on out there in the economy. And I want to start there first, Stephen, with the broader economy, with the economic recovery, and particularly with what's going on in the labor market. How healthy right now is the rebound?
Well, we have seen a significant number of jobs come back. We're about half the jobs that were lost at the peak are now back. But as we look forward, we've also got some concerns, right? Each month, the pace of job growth has diminished. We're beginning to hear from corporations, from corporate leaders through surveys and other methods, that they're actually thinking about doing more belt tightening in the fourth quarter, whether it's in the form of layoffs or restructurings or even kind of freezes. And then the longer term, I think one of the important trends for us all to take a look at is the fact that the pace of adoption of technology has dramatically accelerated. And McKinsey came out with a report earlier this month that basically indicated that companies have accelerated their technology adoption by 3 to 4 years just in this short period of time, which changes not only the nature of the jobs, but potentially the number of jobs that we will be seeing following a rebound.
Lest we forget, as we all get excited about people heading to the polls, people voting, the data in terms of COVID is particularly ugly today. We're nearly at 10 million in terms of the US. We've got Morgan Stanley saying that this is worse than our bear model. We're going to have to potentially see further lockdowns. What do you think that means, Steve, for you, for Goodwill, for people on the ground?
Yeah, so one of the unfortunate aspects of this pandemic and its impact on the labor market is it has hit service workers particularly hard. And these are people who typically have lower income, so they have fewer resources, lower levels of education, so they're less resilient in finding new jobs. And they also represent a higher percentage of racial and ethnic minorities. And so if we think about a potential re-shutdown or tightening again, these people that are just beginning to go to work in some numbers, although they're still disproportionately hit, are once again going to be put in a very difficult situation. So this is very concerning. So Goodwill, we're the largest provider of workforce development services in the country. 1.5 million people come through our doors every year for support, and about 24 million people come to us online. And so we're very concerned about people in these groups specifically because of the need that they will have for employment.
Talk to us more about that. Employers come to you and they often say, we don't have the labor force with the right skills. What skills are they now looking for in this environment? How do you help provide and train those to make sure that you're providing a skilled workforce that employers need?
Yeah, so I think there are a couple ways to think about it. First of all, I would say fundamental gateway skills. So increasingly, anybody who's coming into even the basic level jobs needs some level of digital proficiency. And we, for example, we have a partnership with Google where we've trained over 1 million people, given over 1 million people exposure to digital skills, many of them sort of higher level skills. And of the people that just get more than the basics, over half of them are saying that very quickly they're getting raises, they're getting promotions, or they're moving into higher paying jobs, and also sort of other basic workforce skills. So these entry level gateway skills are essential just as sort of the price of entry. But then also we're finding many more employers saying, I'm not looking for a degree, I'm looking for a specific skill set for a specific job. So it may be a healthcare worker, it may be somebody in a particular technology kind of job, data skills, or maybe credentials in certain trades. And so many employers are saying, I'm looking for that square peg in a square hole. And what we do is we partner with them and we provide people with both the gateway skills, as well as in many cases, these more targeted skills for specific professions.
What are you looking for here over the next 4 years, Steve, no matter who the president is on January 20th? What is sort of the main sort of policy issue that you would like to see accomplished?
Well, there are a few things. First of all, from a government perspective, I think we're looking for the government to look at relevant programmatic support that helps nonprofit organizations deliver exactly the kind of job skills and job support that I just mentioned. We need to be able to take people who don't have those skills, who come to us with, other challenges in life perhaps, and work with them to allow them to invest in themselves and then compete effectively for those jobs. We're also, beyond Washington, we're looking for employers to step up to the plate and say, we are committed to supporting people who need to find jobs. We're committed to looking harder to find the right talent, to supporting people who provide workforce development skills. And when people come to us and get jobs, we're committed to continuing to upskill them so they can continue to compete in a changing labor environment.
You, of course, also work with the Housing and Urban Development Unit, Stephen. I want to get your perspective on, there is much worry about the eviction moratoriums coming to an end, the potential housing crisis. Thus far, the data is just showing that housing is the one area of growth in the economy here in the US. What are your perspectives there?
Well, my perspective on that is housing can switch very quickly. And when people start losing their jobs, they have often an inability to pay for mortgages, an inability to pay for rent. In housing, if you are in a challenging part of, if you're in a challenging situation, like you've recently become unemployed, having a place to live is the most basic form of stability that you need to be able to begin to get your life back. So as we start seeing evictions or other kinds of challenges like that, where people start losing their homes, where they have to move their families, God forbid they become homeless, a lot of other very negative ripple effects occur. And so it's very important to work with people to maintain that housing security through a crisis like this.
Stephen Preston, great to have your voice on today. We thank you, President and CEO of Goodwill Industries International. And do, of course, tune in tonight for our very special coverage. Election, we're all over it. 7 p.m. Eastern, you don't want to miss it. Now, coming up right here, right now, shares of SolarEdge Technologies, they're down. Get this, 25% today, the most in over 5 years. What investors didn't like about its fourth quarter guidance. It's our stock of the hour. That's next, and this is Bloomberg. The impact of another coronavirus wave will be felt, but differently this time round. That's according to the French lender BNP Paribas and their CFO. He spoke with our own Guy Johnson earlier about, lessons learned about the past lockdowns and elaborated on the company's plans for cost cuts and dividends.
If you look at the lockdowns that are being announced today, or let's say this week, and you compare them to what we saw early in the year, they are quite different. It looks like the authorities have learned the lessons. So if you look at it like basically the authorities themselves keep on going, construction can continue. Moreover, if you look at manufacturing can continue, and if you look at services, the service industry has learned from the previous confinement and really is equipped to continue in working from home and the likes. So from that point of view, the impact will be different. Of course, there will be an impact, but it will be an impact which should be different in nature than what we saw previously. And on top of that, see all of the authorities have stepped up the efforts that they have done to support the economy. So they rolling out new things in Europe, or they step it up. Look at France. They've stepped up to 15 billion additional a month of support to the economy. So from that point of view, one has to see how this unfolds, but the lockdowns seem different and include the lessons learned from the previous one.
Nevertheless, the ECB is certainly continuing to impose dividend restrictions. Your ability to return money to shareholders has been limited. So let's talk about dividend policy going forward. The first question on the dividend is, let's talk about the 2019 dividend. Is that going to be paid in 2020, or do you think in 2021? Or do you think we're going to have to wait for later? Is it going to be a 2020 story, a 2021 story? When do you think you're going to be able to pay that dividend?
Guy, sorry, I don't have my crystal ball with me. What I mean is that we have to wait on the guidelines that Europe will basically give. So at this stage, they will come back on their recommendation probably around December. So we'll have to wait for that. If we now look at the 2020 dividends, so the dividends over the results of 2020, those we have been considering that 50% of that, which is our normal payout ratio, we have put aside for dividends to be paid in 2021. Of course, also there we have to wait for what the authorities will do, but that is what we continue to provide for.
Okay, the flip side of that is you continue to focus on costs. You've had positive jaws this time round, which is a good thing. What is your expectation in terms of the bank's ability to reduce costs further? Are we going to see significant layoffs? Certainly banks have been doing that, and I'm wondering what BNP's policy is going to be going into next year.
Yeah, if you look at the costs that we're reducing them in the infrastructure and the likes. So when you look at our staff, let's not forget our staff is fully redeployed, is fully there to support the economy. They have been mobilized, our banks are open, we're really there to serve the economy. And so that is the key thing of what we do. We aim to optimize, but to be there, to be available, to serve our clients and to serve the economy. And that is what we've been doing, and that is what we will continue to do.
All right, the CFO of BNP Paribas speaking a little bit earlier there with our very own Guy Johnson. Now let's get over to our very own Taylor Riggs with the Business Flash headlines.
Thank you, Romaine. We're going to start with Saudi Aramco. They're seeing the third quarter profit fell 45% from a year ago. The world's largest oil producer was hurt by lower crude prices and smaller sales volumes. Still, results suggest that the worst of the coronavirus pandemic's impact on energy demand may have passed. Apple will start to end its 15-year relationship with Intel next week. That's when new Mac computers are revealed, and these Macs will have main processors designed by Apple for the first time. They'll replace Intel chips, which have been a mainstay since 2006. And Humana has raised the lower end of its 2020 profit forecast. The company also beat expectations for quarterly earnings thanks to growing membership in its private Medicare program. Humana expects a loss in the fourth quarter. That's due in part to coronavirus testing and treatment costs. That's your update, Romaine.
All right, great, Taylor. Now it's time for our stock of the hour. We're taking a look at green energy equipment maker SolarEdge, headed for its worst day on record. This after a revenue outlook came up a little bit short. Bloomberg's Dave Wilson joining us right now to talk a little bit more about this stock, SolarEdge. Dave, a couple weeks ago, this stock was at a record high.
Absolutely, and yesterday, the third largest company in the S&P Midcap 400 index by market value, it had more than tripled since joining the index a little more than a year ago. Today, a very different story. The stock headed for its biggest decline since the company went public back in 2015. And as you mentioned, Romaine, it's all about the top line. Their revenue came up short in the third quarter of Analyst average estimate, the Bloomberg survey. That was just the second time that it happened since the company went public, and was the first in about 4 years in terms of a shortfall. The fourth quarter is worse, though. You look at the revenue for the third quarter relative to the average estimate, it's off a little bit more than 1%. Then the company comes out with a fourth quarter forecast that suggests that gap is going to be more like 10%, at least relative to where analysts were before the forecast was made. Yeah, give or take a couple of percentage points, but a much bigger shortfall. And the reasons, well, the company went into them on a conference call. They were figuring that, business has taken a hit because of the coronavirus. They serve both commercial and residential customers. They figured the commercial market would come back sooner as the effects of the coronavirus faded a bit. And instead, it's been the opposite. It's been the residential market that's held up relatively well. So in the commercial business, they're seeing relatively high inventories. Oh, and as far as the virus goes, they're looking to expand into batteries that would store power, the kind of products that Tesla and others are working on now. And they're finding, because of the virus, they're going to be delayed several months in terms of being able to introduce these products. They're looking at early next year just to get them off the ground. They've been hoping to do that this year. And, they're not really going to have it in any kind of volume until maybe mid-year or beyond. And so those are the sorts of issues SolarEdge is facing here. And this has been a fast-growing company that all of a sudden isn't growing anymore, and the shares are taking a hit because of that.
Yeah, a fast-growing company, and was a fast-growing stock. Shares down as much as 25% today. SolarEdge, our stock of the hour. Dave Wilson, we'll talk to you soon. All right, a lot of other stocks also on the move, including Monster, actually higher on the day. Shares of the energy drink maker up almost 2% on the day after being upgraded. Over at Morgan Stanley, we're going to talk about what the analysts saw. That's coming up next in our top calls. This is Bloomberg. All right, time for the most exciting 2 minutes in television. Top calls. A look at some of the movers on the back of analyst recommendations. First up, Monster Beverage. Getting an upgrade today to overweight from equal weight at Morgan Stanley. $90, that's the new target. The analysts expecting a re-acceleration in domestic sales trends, and that when coupled with strong international growth, that's going to drive revenue and EPS to the upside. Shares here up about 1.5%. Next up, let's take a look at chip maker Skyworks, getting praise across Wall Street after reporting a strong forecast and fourth quarter results that came in above expectations. KeyBank raising its price target to $170 from $160. The analysts seeing upside from the launch of the new iPhone 12. Nevertheless, Skyworks shares down 2% on the day. And finally, shopping center REIT Kimco getting an upgrade today to buy from hold. This over at Truist Securities, $14. That's the target. The analyst says shares are pricing an overly pessimistic scenario right now, and that compared to peers, Kimco has less exposure to small shop tenants, casual dining, and entertainment. Shares of Kimco here up 5.5% on the day, and those are some of your top calls. Caroline?
And top calls are something, of course, for many a stay-at-home investor, retail trader to be digesting, Romaine, but also what they might want to be watching throughout the market rumpus as we go towards the election. We hope it's going to be calm, but everyone seems to be getting very much focused on this so-called blue wave. I make you remember back to 2016. There was a 1 in 4 chance that the UK would vote to leave, and they did. The pound fell to its lowest in more than 30 years. 3 trillion was wiped off the stock market in terms of values. Haven soared. Sterling has never recovered. Romaine.
Caroline,
Taylor.
I take your pound and I raise you one king dollar because given this is election night, this has really been the story of 2016. Take a look at massive dollar strength right after the election, that reflation trade, right? The focus on U.S. versus everyone else. Now, of course, we are much weaker, and we'll debate this with Winthin later, Romaine, coming up in the next hour. With massive Fed intervention, you have a lot of calls for further dollar weakness. But if you do see this sort of reflation trade, this refocus on U.S. versus everyone else, you do wonder what that means for King Dollar.
Yeah, and when we talk about sort of trying to sort of handicap what's happening here in these elections and in these big geopolitical events, it's always a good reminder here that you don't always get the outsized moves that you're looking for. In 2008, immediately after the election there in 2008, you did get a bit of a move here in the first week and in the first month. But the last couple of elections, you really haven't seen a major move in the markets. In 2012, that was the Obama victory. And in 2016, when Trump won over Hillary Clinton, it really took a little bit of time for equities to sort of really get their legs. A lot more to break down here. We'll be back in a moment. From New York, this is Bloomberg.
We are counting you down to the close with just 1 hour left in trading. I'm Caroline Hyde.
Dollar weaker here today. Treasuries a little bit softer. Stocks, they continue to rally. I'm Romaine Bostick.
And I am Taylor Riggs. It is green on the screen on this election day. Happy election day. And you are looking at it 58 minutes left in the trading session. And it is all green across the board, especially if we take a look at some of the sectors. You have one in the red, energy, but pretty much everything else. You're getting this rotation out of healthcare, out of staples, really into these big cyclical stocks, Romaine. You have industrials and financials, really the best performers here. And you're really seeing some of that outperformance in that trade go on. When we take a look at the Russell 2000, this, of course, is the only index that hasn't made record highs recently. The last time was back in 2018. But if this is, like today, the big outperformer, this is where, Romaine, you really start to focus your attention on this election day, U.S. versus everyone else.
Yeah, Russell 2000 outperforming on the day. It's interesting to look at some of the volatility metrics. The VIX softening again for another day. Remember, we had seen it get above 40. There was a lot of concern here about the pricing in of that election risk. You take a look at this chart, and you're basically looking at the spread between that November contract and that December contract. Remember, these VIX contracts basically look out 1 month into the future. So when you talk about settlement here in mid-November on that first contract, mid-December on the second contract, you had a high volatility here a few months ago. A lot of people were pricing in the contested election, the idea that we wouldn't know the results on November 3rd, November 4th, or even maybe December 4th. But right now, those bets really pulling back here. A lot more certainty right now, Caroline, that no matter who wins, the outcome will be known sooner rather than later.
But if we go back to what Taylor was saying, of course, she was sort of talking about the blue wave being priced in this rotation trade that's going on. Is the market just getting way too certain? I'm afraid I still harp back to 2016. I'm still scarred from the memories of what happened with Brexit. I'm sure many are in the US with the memories of the 2016 election. The surprise. This, for me, encapsulates everything. Remember, cast your mind back because it looms large, the ghost of 2016, from both polling and market expectations. It looms large. So says, of course, Michael Purvis over at Talbach and Romaine.
Yeah, I remember those days in 2016. I also remember working election night here in the U.S. in 2016. Of course, we were waiting deep into the PM and into the AM and waiting on those results. And of course, the results didn't necessarily pan out the way the market wanted it. And we saw some pretty severe market moves. It'll be interesting to see what happens tomorrow when traders come back. Here for a little bit more insight into what he's watching, we want to bring in Winthin, Brown Brothers Harriman, Global Head of Currency Strategy. When a lot of people sort of have made their bets already as to the outcome of this election, or at least where they think the markets might react to this election, do you think that the current pricing that we're seeing in the markets right now I guess is honest in a way, not necessarily that it's right, but that it seems to reflect the general sentiment?
Yes, it does. First of all, thanks again for having me on this crazy day in a very crazy week. Yeah, look, markets can be right, they can be wrong. We know that. We saw that in 2016. We saw a lot of market reversals that evening. But right now, the markets are, I think, as you mentioned earlier, pricing in what we call the blue wave. That explains higher equities, lower bond prices, lower dollar, and that's on the expectations of aggressive fiscal stimulus being pushed through in Democratic Congress, excessive debt issuance that will require expanded QE on the part of the Fed. To me, that's all dollar negative, equity positive, bond negative. So, it's there, but that doesn't mean it's fully priced in. I think that's where the question is. Is it 75%? Is it 60%? We don't know. And we won't know until results are tallied. But my only point would be that nothing is fully priced in because of the scar tissue that you mentioned. So if we do get the blue wave result, I think there's still room for this trade to go.
Where are you seeing the hedging being placed? Many talking about the Chinese yuan at the moment.
Well, that's a funny thing. The hedging has really broken down the relationship. When we saw stocks falling early this week and last week, we didn't see treasuries rise, and gold was down. So a lot of the normal metrics don't really work. I think a lot of people are long volatility because they're not sure about the directional bet. But if you expect volatility to go higher regardless, then being long volatility would sort of hedge those risks. But I don't think there's any cookie cutter way. I think everyone is approaching this very differently. But everyone, I think, expects much higher volatility and potential for really disjointed market moves.
We were talking in the last segment about King Dollar and the big strengthening that we'd seen in 2016. What moves in the dollar are you expecting, not only tonight, but in the coming weeks, if it is hinged on the election or if Jay Powell rules the day?
Well, I go back and forth and look at all the drivers, and to me, I can't find anything positive to say about the dollar besides just the occasional safe haven bid that we've seen that off and on over the last couple of weeks. Why do I say that? Well, we talked about the blue wave. We're talking about excessive budget deficits. We're talking about the twin deficits. We're talking about increased debt issuance. That's going to be requiring the Fed to ramp up its QE and expand its balance sheet. So what we've seen in the past, in those early days of another round of QE, the dollar typically suffers. The Fed's ultra dovish. They don't want any kind of rates to go higher at the short end or the long end. We go back to 10-year around 0.990. I don't think the Fed is happy about that. They've been clear they don't really want monetary conditions tightening for several years. So to me, the ultra dovish Fed, potential for QE, and I have to mention the virus numbers. We're going to see economic underperformance in Q4. Those to me are all net dollar negative for the near term. Now, 2021, that's a different story. But for the next 3 to 4 months, I'm pretty dollar negative.
Wow. And with that dollar negative view, though, Win, I mean, the idea here is that if you do see an economic rebound in the U.S. that outpaces the rest of the world, at least the countries that would be the most relative to the U.S., would that actually confirm that thesis, or would it shift it in any way?
No, you hit the nail on the head. Okay. When you go back to 2007, 2008, the dollar weakens on those initial rounds of QE. Every round of QE, the dollar weakens. But you're setting the table for a rebound, an aggressive rebound in the U.S. economy. You're setting the table, in a sense, for a good rebound. So yes, that I would expect the dollar to recover, but it's a big if. As Mr. Powell has said, you cannot have a sustainable economic recovery until the virus is under control. And that to me is the missing piece. The virus numbers here are continuing to go up. Obviously, we're seeing this also in Europe and the UK. I have a little more confidence they can get the numbers down because they've done it before. But here in the US, we haven't done it yet. So something needs to change for me to turn more positive, so over the 6-month horizon. I'm hopeful that we get this virus under control, but that's really what to me is the big question mark.
Within, take us on your train of thought there, because we've just had notes out of Morgan Stanley today saying, look, at the moment, there's almost near 10 million cases here in the US. It's ticking above the worst bear case scenario they had, and therefore seeing further lockdowns. What does that mean for the US economy? What does that mean on the ripple effect for the US dollar?
Well, what I think is that, regardless of an official lockdown or not, people are rational. If you see virus numbers exploding, any rational person is going to say, you know what, I don't think I'm going to go out to that bar and have a drink tonight with the risk of getting it could be not just death, but obviously they're talking about serious organ failure, et cetera. So to me, the risk at some point, the rational actor will tells you, regardless of the official lockdown, that hey, I've got to adjust my behavior. So that's what I'm seeing, and I think that's what we're going to see in Europe. If you want an example, look at what's been done in much of Asia. They've really shown the world how to control this virus and how to reopen in a smart manner, and the blueprint is there. I thought the Europeans had done it, and I think they reopened without really much regard about the risks that are still out there. So, I think the bottom line is we're going to have to live with this thing for quarters, if not years. And I think the argument that we're going to be at substandard growth for quite a while growing out. So, it's the Fed's message of lower for longer, really resonates. We'll know more on Thursday when Mr. Powell gives his press conference.
You mentioned China earlier in your comments, assuming if dollar weakness means EM strength across the board?
No, I would say that's a very good question. I think we've seen divergence all year, and we actually even seen that in the majors as well, but particularly in emerging markets. We've had the bad apples, obviously Brazil and Real, Turkish lira. Yuan has been one of the strong performers, same with Korean won and Taiwan dollar. So I think you'll see divergences. A lot of that is based on how well each economy, each country has done in controlling the virus. When you control the virus, you can reopen the economy and growth kind of starts up. And I think China is leading that charge. So the greater China region. Indonesia and India are not doing so well. They've not, followed, the blueprint. The U.S., Canada, Latin America, UK, Europe, all very problematic right now. So look, I'm an economist. I shouldn't be talking about relative infection rates, but that seems to be what could be a determinant of sort of the medium-term growth outlook, near to medium-term growth outlook, for major economies.
Seems as though everyone is forced to a certain extent to know more about healthcare than we'd ever like to. Win Thin, Brown Brothers, Harriman, we wish you well over there in Brooklyn, Global Head of Currency Strategy. It's going to be a long night for you, and we thank you very much for spending some time with us ahead of it. Now coming up, it's a $35 billion suspension. Why China stopped the listing of Jack Ma's Ant Group when it was expected to be the world's biggest IPO. Plus, still looking for stimulus, why the market might turn its focus on the potential of a bill after the election. And PayPal plummets, why the company's earnings report stopped the pandemic-fueled momentum. All that and more coming up. This is Bloomberg.
All right, welcome back to Bloomberg Markets to Close. Counting you down to the close, 45 seconds to go here in the trading day. Risk on sentiment seems to be the word today. 2 straight days of gains here in the S&P 500 as we head into the U.S. election, awaiting those results potentially tonight, potentially tomorrow. Who knows? But right now, the sentiment right now appears to be that stocks will go higher. You're seeing your 10-year yield go down slightly, up, today, slightly. You're seeing a little bit of a sell-off with a little bit of steepening here with the long end of the curve heading up. Dollar weakness today. We should point out, though, the trading in the dollar is relatively thin. We just heard from Win Thin saying he expects dollar weakness to sort of be the word, though some of the technical indicators point to a little bit of dollar strength. You take a look at the NASDAQ 100 and some of the weakness that we saw in tech last week, that's being unwound today, seeing pretty strong bids come in for Amazon, Alphabet, Google, Facebook, and the like. Tesla up about 5% on the day as well. Small caps, they're the outperformers. If you're looking for the big outperformers in that small cap space, you're going to find it in discretionaries and in healthcare, Taylor.
Thank you, Romaine. I do want to take a look at some other corporate stories that we're following, and it shares of Bristol Myers Squibb. Those are higher today. A late-stage trial for a psoriasis medicine met its main goals. The study showed that more patients achieved at least 75% improvement after 16 weeks of treatment. Crispin Odey stepping down from running the hedge fund firm he founded nearly 3 decades ago, all to focus on managing client money. He will oversee a new hedge fund at his London-based Odey Asset Management that will focus on the prospect of higher inflation. The move comes after a tumultuous period for one of the best-known hedge fund managers in Europe, with his main fund suffering losses and investor flight. And shares of PayPal are falling today. The company lowered its full-year revenue forecast. Plus, it said growth in the third quarter slowed from the blistering pace of the first half of the year. PayPal has been a big winner in the pandemic. Shares were up more than 70% in 2020 all before today. Caroline, those are some of the high flyers, of course, that we talk about this year.
Yeah, maybe a little bit of profit taking coming on the back of PayPal. We will stay tuned for that one. But now let's get you more market insight. Options Insight is with us, Abigail Doolittle. And Abigail, I mean, another look at volatility, I feel, is in order.
Absolutely, very appropriate for the day. And interestingly enough, Caroline, we actually have volatility, as Romaine was just outlining, falling for a second day in a row. Matt Rao of Headwaters Volatility, thank you so much for joining us. And that VIX, not so long ago, late last week, had been close to 40, now below 35. The last time we spoke, about 2 weeks ago, the VIX curve at that time suggested to you that it may not be until December 8th that we would know who the next president is. But now the messaging is different. Talk to us about why.
Yeah, it seems that the market participants have sort of taken the opportunity to sell that volatility premium and bring the market interpretation back to looking as if we're going to get some sort of a definitive answer by the end of the day tomorrow. So specifically, if you look at November 4th versus 5 and that little calendar blip, that looks like what people are expecting is that there's going to be some sort of a definitive result that you can rely on by the end of the day tomorrow, not late tonight.
Yeah, that VIX curve coming in just a little bit. And relative to our conversation not so long ago, you're saying that many of the indications are pointing to the possibility of a blue wave. It's interesting, if we look at high-tax companies relative to low-tax companies are outperforming. What else are you looking at, Matt?
Yeah, I think people are looking through the election, and this is sort of the beginning of the event, if you will, and maybe not necessarily the event itself, as we've said. So in the short term, I think a blue wave means higher probability of substantial stimulus, which, of course, the market really likes and is leaning on. But in the longer run, and longer run being relative, 3 months, 6 months, 1 year, I think people are reasonably expecting higher corporate tax rates, higher tax rates at the top end, and they're trying to price that in. And so, for example, since October 1st to today, the Russell 2000, which is largely small cap companies, is up a little over 5%, where the NASDAQ is down almost 3%. So there is a big separation there, and I think that the market's starting to price that in if you want to read through to that.
That's pretty interesting. And the S&P 500 chart over the last 3 months, really in this range of uncertainty, suggesting that perhaps it could play out longer. Ultimately, do you expect, well, first of all, do you expect this week's gains to continue? And what do you expect with that range? To break to the upside, just continue sideways, or to the downside?
Well, we try to look at things and be somewhat agnostic to direction. And, so we look at implied distribution. How much does the market need to move up or down? And right now, 18 implied volatility for an option needs a roughly 2% move over the course of 4 days to break even, and we're getting a 2% move today. So, you can see where I think that from a risk-adjusted standpoint, being long volatility through this event is still a responsible and rational thing to do. You just have to be careful how you do it. Buying put skew or out-of-the-money puts is sort of a widowmaker, whereas there are more creative ways to do it that we like.
We'll leave it to the professionals such as yourself. In about 10 or 15 seconds, Matt, talk to us about your longer-dated option strategy after the election.
Yeah, I think that looking at implied distribution is a very good way to do it. Try not to be too much of a directional hero, and I think it's reasonable to assume that the next couple of months are going to be hard to predict, no matter which team wins in this event.
I like that, Matt. Try to be directional, not be a directional hero. Good stuff right there. Matt Rao of Headwaters Volatility, thanks for joining us for Options Insight as always. And from New York, this is Bloomberg.
We've continued to say if this weren't election day, this would be the story of the day. It's Ant Group's now postponed IPO in both Shanghai and Hong Kong after China suspended them both. Here, of course, we're taking a look at shares of Alibaba. They're now off more than 8% in today's trading on the ADRs. We know that they own a third of Ant Group. For more on this and some of our other emerging market action, I want to bring in Sherry on, who is the host of Bloomberg Daybreak and Australia and Daybreak Asia. Sherry, I think what's interesting about this story is we're 2 days out from the IPO. How did it get this far until regulators stepped in?
I think everybody's asking the same question, right? They were supposed to start trading on Thursday, and just now, regulators are coming out and saying that they are halting the tradings both in Hong Kong and Shanghai. It's really interesting because, of course, this was very much anticipated. The only reason that they're giving is that there has been a significant change in the regulatory environment. No more details of what that actually entails, and this, of course, as you've seen, has led to this slump in Alibaba shares, and Alibaba and Ant Financial, Ant Group, coming out with this statement apologizing to investors for any inconvenience that they might have caused, that they will handle follow-up matters in accordance with regulations, that they will overcome the challenges. But people who have been watching this IPO very closely now speculating that perhaps it was a speech from Jack Ma 2 weeks ago that led to Beijing regulators being antagonized and sort of leading them to put the reins on this listing. Jack Ma accusing regulators of restricting innovation, saying that the biggest risk in China is not a systemic risk, but the lack of a financial ecosystem, saying the Chinese banks are like pawn shops. So we have seen some signs of problem. On Monday, Chinese officials had summoned Jack Ma. We were all wondering what this was about, and now this has happened.
So what's it going to take here, Sherry, for Ant Group to get this IPO back on track, if at all? There seemed to be a lot of talk about the way Ant was effectively, I guess, to a certain extent, sort of off balance, keeping most of its liabilities more off balance sheet, and this idea here that they would have to keep a larger percentage of their loans on their books.
Yes, because they have only so far kept about 2% of those loans on their balance sheet. And our Bloomberg opinion columnist Julie Ren coming out and saying perhaps you'll have to match what other commercial banks in China do, which is about 30%, and no longer act as a matchmaker for banks and lenders, which is what they've been doing so far. And they've been getting a lot of criticism from commercial banks, complaining to local media. So perhaps this could be an aspect that might be overhauled. In the meantime, though, Ant now scheduled to return the funds it's collected from investors on this IPO that was supposed to raise at least $34.5 billion. So really an extraordinary rebuke, a last-minute rejection of this IPO.
Very briefly, Sherry, while we potentially see banks winning in the short term, inherently this is a knock to the entire financial system of China, right, to a certain extent?
No wonder we've seen the reaction in the markets. We are seeing on those ADRs from Chinese firms all under pressure, because remember how many times we've talked about this huge IPO in Hong Kong, in Shanghai, being a sort of a renaissance of these homecoming listings for Chinese firms, and also a huge boost for Hong Kong, the financial markets, which have been under pressure, or Shanghai, that's been trying to build itself up as a tech hub.
One to watch, Sherry Ann. I'm sure you'll be focused on that. And of course, the US elections, host of Bloomberg Daybreak Australia and Daybreak Asia. What an extraordinary story. Meanwhile, let's take you right back to where US is trading, because today is a day of rotation. Today is a day of getting into industrials. Dow Jones Industrial Average, your best performing industry group. Russell 2000 as well, also on the upside. Money going into oil, and even seeks a bit of a bid in gold as dollar goes lower. This is Bloomberg. The day is upon us. We have but half an hour left in the trading day of Election Day. This is Countdown to the Close. I'm Caroline Hyde.
I'm Romaine Bostick.
And I'm Taylor Riggs. And at least from a sector perspective, breadth looks pretty good. Like we said, just 28 minutes into the session until we get that closing bell. But only one sector in the red, and that is energy. Everything else remain firmly in positive territory. It's a very cyclical risk-on rally with industrials, financials, discretionary, even tech up there, some of the big outperformers relative to the S&P 500.
Yeah, and when you look at some of those individual names, you take a look at Arista Networks, of course, a big network equipment company there, really having one of its best days in quite some time after providing Q3 earnings that beat estimates, providing 4Q guidance that came in above expectations. Cirrus Logic, the big Apple supplier, also moving higher here on better than expected results. McKesson, this is interesting, the big drug distributor here, moving higher on the day after its earnings. And that's really pulling up this whole space here. So keep an eye on Cardinal Health and some of the other names as well. And then, of course, we've been talking about it all day. Alibaba really getting caught up in the drag. That Ant Group IPO, of course, being put on ice by Chinese regulators. That's the behemoth financial company controlled by Jack Ma. His other behemoth company that he controls, Alibaba, down 8% here on the day, Caroline.
Such an extraordinary story, one you might have missed amid the election. And this is another one that I think people are missing on this day of green risk on trade. I hate to be the person pouring rain upon that parade, but look at what's happening in terms of COVID. This is what Morgan Stanley's been writing about today, and it caught my attention. The fact that they are worrying that we are ticking ever higher. Look at the white line. We're near 10 million in terms of those who have been infected in COVID in the United States. And they're saying it is getting worse. It is ramping up. It is worse than their bear case. And we might have to see lockdowns here in the United States as well. We've seen the damage that that's had upon the stock markets over in Europe, Romaine. What does it mean for the stock market here in the US?
Yeah, and what does it mean for the economy? I mean, there was a great guest who was talking about this the other day on Bloomberg, that when you talk about economic policy in this nation, whether it's from Donald Trump or whether it's going to be from Joe Biden, economic policy at this stage, Taylor, is pretty much COVID-19 policy.
Yeah, exactly. Certainly, at least how small businesses think about the reaction in terms of re-shutting down versus trying to just reopen and get through it, because if they shut down, they can't handle it. So certainly hearing a lot from both sides of the aisle. Another thing that's interesting that we're hearing about, Romaine, is the way the markets continue to react. This is interesting. Yesterday, or was it this morning? My days are all screwed up. Investors pulling the most cash ever from the world's largest ETF. This is the one that tracks corporate bonds. Joining us now for more, Bloomberg's Katie Greifeld. Katie, we're talking about LQD, and I'm wondering, what was the impetus for the big withdrawals? 1.4 billion.
Yeah, it's huge. It's well past the record outflow that we saw back in March. And I was talking about the bear case with Peter Chatwell from Mizuho earlier today, why we saw this before the election. And if you think about the setup, it could be considered a lose-lose for a fund like LQD either way. Credit is thought of as a risk asset. You know, it tends to loosely follow stocks. So there's a big risk off move that could drag LQD lower. But then you look at LQD's duration. That's basically its sensitivity to big moves in interest rates. It's pretty high. It's at 10 years, which is well above that of its peers. So if we did get a risk on move that sort of drove interest rates higher, that duration risk could bite LQD as well. So if you add all of that together and consider the fact that LQD is up about 17% since March, it makes the sense that investors are looking to take a little bit of profit here.
What type of investors are they? Is this mainly retail voting with its feet?
It's interesting. I mean, LQD is such a huge fund. It's the biggest credit ETF at about 50 billion. So it has a pretty diverse user base. You definitely have some retail investors in there who get exposure through model portfolios that their financial advisors set up. But you also get a lot of big institutions who are using ETFs as sort of a liquidity sleeve. And if you really drill down into trading, you can see that there was a big trade yesterday at about 200 million. So a trade of that size, we're not sure if it was a buy or a sell. It probably was a sell at this point. But that really can only be done by someone with a lot of money, one of those institutions.
I'm wondering, though, too, I mean, this does seem to be the work of sort of a big player here. I am curious that from the retail investor side here and the way that the individual investors had embraced this ETF, whether they're also sort of moving out the door or whether this is simply maybe folks just moving money around for the moment and maybe LQD will get its day to shine in a couple of weeks.
That's a good question, especially when you look at what's going on in the primary market. You are seeing some deals get pulled or delayed, which typically tells you that issuers are just worried about that there could be sharp price movements in the day ahead. So it's reasonable to think that that sort of calculus could be going on in the secondary market as well, that perhaps people think that, you know, there's just going to be a lot of volatility. It could hit the credit markets. Maybe I'm going to hide out in cash, especially when, again, to get back to that duration argument, you might not want a lot of interest rate exposure at this point.
Good answer, Katie Greifeld. We thank you. Great to have you with us. And we will be, of course, looking at all things in markets throughout the rest of trade. We have about 22 minutes to go. This is Bloomberg.
All right, welcome back to Bloomberg Markets. The close about 20 minutes away here from the close of trading. And the risk on mood here is prevailing, of course, as millions of Americans head to the final day of polling today here in the United States of America, seeking to elect the next president of the United States. It'll either be Donald Trump for another 4 years or Joe Biden. Markets had been skittish about the potential outcome of the election, but also about the potential that we wouldn't know the outcome. Joining us more to talk about some of the election risk out there, as well as just general broader market volatility, we want to welcome Chris Ailman, Chief Investment Officer over at CalSTRS, which has about roughly $258 billion in assets under management. Chris, always great to have you, and especially great to have you on a day like today where there's so much noise here surrounding the election and what it means for the economy, what it means for the markets. Let's talk about the general idea of uncertainty, the idea that a few months ago the market was pricing in this idea that we would not have any real clarity as to the winner of the election until maybe weeks, if not months later. What do you make right now of the general volatility in the market and the possibility of what we will know about the outcome of November 3rd?
Well, Romaine, I still consider that a strong risk. Although the market has priced it in, and I hear from street analysts less than a 10% likelihood. When I surveyed my investment team, we thought that was probably closer to 25%. And the rhetoric last night that I heard on the campaign trail still makes me worried that if one person doesn't win, that they think then automatically the election was contested. I'm hoping that we see some pretty clear results, and at least by tomorrow I'll have a strong feeling. But even then, the transition, if there is one, I'm worried about that. I just don't think the market has priced in the uncertainty and the volatility that we may face finishing up this election. Longer term, I think the market's in a good place, but right now I'm very cautious.
Sort that for us then, the short term and the longer term, because you are inherently one of the most long-term focused investors out there, of course, long-term money to put to work. How do you offset some of this short-term volatility?
You know, Caroline, it's got to be just with diversification. We debated whether to hedge the portfolio more and be more in like 30-year bonds. We wouldn't use long-dated options, as was mentioned earlier. But we decided to remain neutral because there's just too much uncertainty about what could happen today with the election and whether the results are validated and accepted, and then how the market would react to it. As you've talked many times in elections, most of the impact to the market is fairly short term. So frankly, the biggest risk that we're facing is lower interest rates, lower for longer. And that's got our attention, and that's what my board's been talking about.
So let's go there, because diversification sounds great on paper, except for recently, bonds aren't correlated the way they used to be with equities. They're acting differently. What then do you do in terms of diversification when that bond and equity market isn't behaving the way it should be?
Well, Taylor, it's tough. For a 401k investor, bonds are about the only thing they can do to diversify. They can look at non-US, and obviously right now, small cap stocks are a bit of a diversification away from the technology. In our case, we've got things like real estate as a long-term investment, infrastructure as an investment, and then we have a category of risk mitigating strategies. Those are specific strategies that only an institutional investor can tap into, but that helps us diversify away from just equity growth exposure. Right now, we are completely diversified. We're right on top of our benchmarks. I've said before, we're aggressively neutral. We're within 1% in each of our target allocations. So we're not willing to take a bet, bullish or bearish, today before this election.
We want to be sticking with CalSTRS CIO Chris Ailman, of course. Throughout the build-up to the close, we have but, 15 minutes to go overall, and we want to get you a quick market check. Let's have a look at what's happening in terms of overall industrial reaction. We are seeing money going into the Dow Jones Industrial Average. We are seeing, of course, the Russell 2000 currently outperforming, up 3 percentage points at the moment. Crude oil currently up 3%. Guys, I've got to look at gold, also getting a bid, up 0.8%. And Romaine, this is really where we're seeing some of the bid come in terms of the rotation trade.
Yeah, some of the big coming in that rotation trade. Keep in mind, you're not only seeing the precious metals bid up, but you also saw the industrial metals also get bid up here on this day. So there does seem to be the general sentiment here that you have an economic recovery globally. You have, at least in place to a certain extent, fiscal and monetary policy that is supportive. And the idea here is that the outcome of the election, no matter who it is, that those trends will continue. Now, whether it's going to be that straight line that some people are anticipating, that's certainly up for debate here, Taylor. But that seems to be the bet. The reflation trade is what you're looking at right there.
Yeah, and this, how much of this as well as a reopening trade? The transportation index is now up 3.2%. I'm looking at some of the biggest movers in the index today, and frankly, it's a lot of the airlines, of course, that we are seeing. And even, Caroline, as you were mentioning, some of the rising cases, really trying to see some of the transportation stocks, even the shipping, perhaps, as we all know that this is the new normal, really start to be some of the big outperformers today.
And of course, we take it cross-asset. We look at what bonds are doing. There has been a sell-off. We have seen the yields pushing up higher. But as for once, we'll see maybe that 60-40 portfolio really working on that back of that. But really, it's been a case for me of dollar weakness as well. And whether that's actually pushed overall asset movements today, Romaine. That's why we got a bid for stocks. That's why we got a bid for metals. In fact, for once, we got it for gold.
And let's not forget, the U.S. election isn't the only big thing this week. Of course, a lot of economic data. The Fed, of course, you get that Treasury-free funding announcement tomorrow. We're going to break it all down when we come back. This is Bloomberg.
This is Countdown to the Close. I'm Caroline Hyde.
I'm Taylor Riggs.
I'm Romaine Bostick.
Let's check out how those majors have outperformed on the day. We are rising sharply. We continue to power higher, particularly in the rotation trade. Today is a day of industrial strength. Today is a day of, well, small cap strength as well. That is in your blue line. The underperformer only slightly. Well, yellow is your big tech, NASDAQ, and white is your S&P 500 on the still up more than 1.5%.
Yeah, and a steepening of the yield curve giving a lift here to financials of the KBW Bank Index up about 3% here on the day. Drug distributors also higher. We were talking about McKesson a little bit earlier. They came out with earnings. That's giving a boost to Amerisource, the Cardinal Health, and a few others there. You take a look there, what's going on with some of these communications companies. Arista Networks out with earnings. That's giving a big boost there. Their earnings not only seem to be a big read, not only on what's going on with the company, but a broader read about spending a lot of that network equipment there. And then there at the bottom of your screen there, you can see one of the main solar ETFs there, TAN, SolarEdge, the biggest holding in that name. That was our stock of the hour, last hour, down about 25% for that stock, down about 2.5% here on the ETF right now, Taylor.
Let's get straight back to, of course, Chris Ailman, CIO of CalSTRS, all-important voice on this day. Chris, your take on how much has been priced in terms of a blue wave and whether that's the right thing to have done. Solar stocks, as we're just hearing from Romaine, one down on the day, but what a phenomenal outperformance as they're beginning to bid on Biden.
Yeah, no, I would agree. I think irregardless of the today, I think we'll get past today, and I think they have priced in a blue wave. And it's going to be long term, but I think we really do have to turn to climate change. That's got to be the focus in the next 4 years. And today, I should say, correct myself, today is material about how that will be addressed. I think that there's no question that we've got to begin to adjust our energy mix and do it in a right and just way. You can't just shut off hydrocarbons. You've got to shift slowly, first with electricity. And then, frankly, a lot needs to be done in agriculture. So that's going to be a major theme, I think, going forward. Yeah. The other big theme is going to be, as you discussed today, China. That's a story that you said should be the headline.
Well, talk a little bit about that because, of course, I mean, the last 4 years have really been dominated by discussion about the relationship between the U.S. and China and really the relationship between China and the rest of the world overall. I mean, what's your general outlook here with regards to not only that diplomatic and political relationship, but the economic one?
Well, it's that difficulty that is confronting my fund. We have a market weight exposure to China. What's been interesting, Romaine, is that has gone from a very small exposure to where now China, even though it's just 3%, it's our largest single country exposure. And the question that my board's going to face, and we're going to talk about at the beginning of 2021, we know China's a friend, but we also know they're a foe at the same time. And with some of the questions about funding their military, the growth of their Navy, it really makes it difficult for an investor to stay there for a long time. The news today just amplifies that you can't fight the party. You've got to be on their side if you're going to make money. And the question is how much they're going to let you make money. So I think it's a conundrum for any investor.
But Kristen, I mean, when you talk about sort of what transpired here with Ant, and we don't know all the details, but the idea that you would have something like this put on ice as quickly as it was done, and for reasons that don't seem to have anything to do with maybe the fundamentals of the company specifically, does that give you pause, though, as an investor of, I guess, increasing that exposure? I mean, I know your exposure is small, but I mean, if this is sort of the holy grail for growth with regards to a people and a population and an economy, how do you do that when you have a government that can make sort of these wholesale decisions about the future of a company the way it did with Ant today?
You hit it on the head. I don't have an answer yet. That's something we want to study, and I don't think there's a clear answer. I used to ask my board, is China a friend or a foe? And now I've realized the answer is yes, both. And that makes it really hard. So no, and it's not just this issue. I mean, you have to know when you invest in China, it's all about the party. And whether Jack Ma, whatever he said this week, it clearly had an impact on postponing this offering. So it's an indication, again, that it's a one-party system. It's communist. You can make money there. It's going to have a growth economy, but it is full of E, S, and G issues. Some investors are going to turn a blind eye and just don't care, and the traders will make money. But as investors, it's a real conundrum for us. And I don't have a clear answer about whether we should be underweight, overweight, or market weight in this growth economy.
I love that you were shining a light on that important story today, which could almost be overlooked because of the election hype. Let's dig deeper into some of the action that you might have missed. Taylor, take it away.
You know, Caroline, we're talking to the man who says that diversification, right, is the way to diversify and to protect yourself from market and moving events. So let's take a look at volatility within equity, bonds, currencies. And you see it here, of course, VIX spot higher than November and December contracts. Bond volatility moving higher as well, of course, bond market vol, now the highest going back since June. Currency volatility rising just a little bit as well in October. So you're seeing a little bit of some slow increases here, but nothing like we saw in March. I want to talk about volatility back in the equity markets. It's my stock of the hour. It's shares of Uber and Lyft. Big day for them today. Prop 22 out for voters today. This, of course, would determine whether they are classified as freelancers or employees who deserve full benefits of being full employees of Uber and Lyft. So those shares at least positive today, hopeful on a Prop 22 outcome that they want. And I do want to turn back over and go cross asset. And Chris Ailman, I bring you back in on this discussion. Take a look at a 10-year yield. Now you're above the 200-day moving average. You're getting a big lift up today. But still long term, Chris, the trend is lower for longer. And in your last segment, you did say that lower for longer is your biggest threat. And I'm curious, it's a politically unpopular opinion to lower a discount rate, but does 7 and 8% discount rate make sense when you have 10-year bonds at 88 basis points and 30-year bonds at a 166? How do you think about that?
Taylor, it is a debate I had just yesterday on the phone with several of my board members, and our meeting is tomorrow. So I think it will be coming up under my CIO report as another debate, but it's a long-term question. Is 7% a hard rate of return and a high hurdle in the next 4 to 5 years? Absolutely. It's going to be very tough when fixed income is yielding so little. But remember, I'm investing for 30 years. So part of the challenge is lower for longer is going to be the norm for, let's say, 4 to 5, maybe even 6 years. But does that mean that in the next decade, in the 2030s, I can't make 7, or the 2040s, I can't make 7? That's why there's a hard debate about whether you really adjust that rate now. Remember, these benefits are intergenerational. So they're not just for the baby boomers. I'm investing for Gen X and the millennials.
And you're potentially looking to eventually invest for Gen Z as well. And I turn our attention to a story that caught our attention that Taylor was mentioning that is very much front and center in California, front and center in the board of yours that meets tomorrow, is the future of a business model for something like Uber and for Lyft, two companies that were such darlings ahead of their IPOs and have suffered the consequences, of course, of the pandemic, but also of regulation. How do you look at what's on the ballot this particular year in terms of in California, it's about Prop 22. We're hearing legalization of marijuana in further states. California is already ahead of that. Where do you look in terms of business model growth from this?
You know, it's interesting, Caroline. It is such a challenge. The idea of freelance work is very appealing in terms of trying to get to full employment for a country. But then there's a question about living wages and basic benefits for people. So From our perspective, we don't forecast that. It's very difficult. I've mentioned before, companies that lobby seem to, unfortunately, outperform in America. But the question is going to be about regulations across Europe as well, not just for the Uber and the Lyfts, but companies like the social media companies. What's going to be the future? And I think we're going to hear those kinds of discussions depending on, in the USA, which party's elected, but we're going to hear it out of Europe a lot. Because they are very concerned about proper regulation.
And so, I mean, does this provide any sort of, I guess, a meaningful speed bump for big tech, for these mega cap tech companies, and more importantly, I guess, for the market growth that they've provided investors with over the last couple of years?
Well, Romaine, it's got their attention, that's for sure. You look at the amount of money they've spent just in California on their propositions and understanding the risks that they face in terms of how they operate. But I think I think big tech is making money. So we're in a much better position than they were way back, let's say in 1999, where it was all smoke and mirrors. Now they're actually generating income. And so far, the health crisis isn't over. So big technology is certainly outperformed every other subset of the equity market. It is shocking how poorly the Russell 2000 has done during this year.
And perfect timing as we get those ringing of the bells. Shocking and the underperformance this year of the Russell 2000. Pretty shocking its outperformance on the day in the rotation trade we've seen. We're off our highs, Romaine, but still the S&P 500 putting in a 59-point surge. We're eating away at that sell-off that we saw last week.
Yeah, and I mean, look, if you got a Bloomberg terminal right now and you throw up a cross-asset board, pretty much everything is in the green here. The only thing that's really in the red today is the dollar. So you're talking, and the VIX, so I should point out as well. But basically any sort of risk asset out there right now has moved higher. It'll be interesting to see how these trades, this idea of a reflation play here, Taylor, plays out based, of course, on the outcome of the election, whether we know the outcome tonight, whether we know it tomorrow morning when we come in, who knows. We should point out that, of course, we're going to have full coverage right here on Bloomberg television, of course. And if you have a Bloomberg terminal, you can check out one of our blogs, TLIV or MLIV, on your Bloomberg terminal, Taylor.
And you, great promo, Romaine. Just off the cuff, so smooth. Yeah. You take a look at 10-year yield up 4 basis points on the day, 88 basis points, the highest since June. Caroline, we'd started this conversation mentioning the Russell 2000 best day since July 15th. Still, though, only putting it back to the high since October 23rd. And that was one that we were focused on, given the focus on U.S. domestic policy, U.S. versus everyone else. And, of course, the only index that hasn't made a fresh record high earlier this year. And then the transportation index as well, best day since June. So really starting to see in some of the other indices outside the majors, risk on.
Risk on. Risk on it was. Money moving out of bonds, money moving out of the dollar. Let's get back to Chris Ailman, of course, Chief Investment Officer at CalSTRS. Your take now, take a deep breath. We all sit and wait and look across our news outlets. But tomorrow, what do you come in with? What sort of head do you have as a key investor?
Well, I think you hit I don't know that we'll know for certain. I hope that we do. I'll be watching a little bit about the election results, but I'll actually be turning on Bloomberg and hoping you're showing Bloomberg Asia, because I really want to see how the markets trade in Asia and in Europe overnight. I remember 4 years ago, I very quickly turned off the election news and went straight to the markets because they reacted so violently. I hope it's a bit calmer given today's bullish sentiment in the market. And then I think we're going to have to reevaluate once we get through tomorrow and hopefully know the results. We're all going to suddenly have to worry about if there is a transition. Is it a smooth transition? There's been nothing smooth and easy about these last 4 years and nothing predictable. So that's going to be an uncertainty. But I'm looking longer term. The Federal Reserve is still going to be in charge and Powell's going to be lower for longer, for a longer time. That does mean risk on in some opportunities, and it means that people will continue to borrow. But the bottom line is it's still a health crisis, and that is not resolved. And even if we find a vaccine, boy, I'm seeing numbers less than 50% of the people that would be lining up to be taking a vaccine. I think there's going to be a lot of wait and see, and we're still going to be stuck in this health crisis well into 2021.
Hey, Taylor, can I make a point here to Chris, what he just said about sort of looking at Asia markets overnight? Because, I mean, this was sort of something that transpired back in 2016. And tonight, I mean, you're looking at the offshore yuan and sort of the overnight implied volatility, it's actually about double, almost triple what it was, Taylor, in 2016, leading up to election night there. So I think the jitters here are definitely well-founded, at least as far as the market data is concerned.
Yep, and you can start to see that in dollar and yuan. We'll be chatting standard deviations all night, if that's what you guys want.
Is that what we're
Let's
doing?
go back to Chris Ailman here. It's funny, you mentioned the Fed. We pushed forward to Thursday. I'm curious about how you're thinking about pockets of bubbles with bond yields low, valuations in the equity markets looking high. You said you're diversified. Do you see pockets of bubbles anywhere else?
Well, Taylor, when you think about bubbles, it's so hard to identify them beforehand. Prices are at extreme valuations. I mean, just look at the earnings season that we went through. It was okay, but several of the tech stocks are down because expectations were in bubble territory. They were unrealistic. There have certainly, when you look at the relative value, emerging markets has been not doing well and trash for 3 years. As you mentioned, the dollar has swung between strength and weakness during this last 4-year period. And then just the fact that small cap value has just been unfavored in this entire time. Maybe some of that's justified because of the virus and the low economy. But I think there are some areas where the market is out of whack, we'll say, not bubble territory, but some extremes that should eventually come back to normal ranges. Relative strength should come back in particularly small caps.
Chris, I have to ask you sort of long term. I mean, being a manager of retirement money effectively here, you're dealing with basically a zero interest rate environment, more or less here, and one that's probably going to stay that way for at least the next few years here. How do you sort of, I guess, deal with that potential of not really having a treasury market to depend on for returns, and at the same time still have to keep your portfolio balanced?
Well, Romaine, I think it was earlier Caroline mentioned 60-40. 60-40 is something that's like 20, 30 years ago. If you look at most of the public pensions and certainly the endowments, they're 80-20, 80% equity, 20% fixed income at most. Our fixed income allocation is actually all the way down to 12% because we're looking for other areas to diversify. Now, people aren't going to have the options of just going into bonds. And, you've been getting a double digit or a high 8% return out of bonds on average for almost 30 years. That's over. In the rest of our lifetime, you're going to have lower rates. But what you have to look at is other places you can diversify. That also means that you're going to see people like the private equity world where they're going to borrow at those really low rates and leverage up their opportunities. And as an institutional investor, you can look at real estate. Now, obviously, office is a huge question, what that will be going forwards. But these fulfillment centers, tech centers, medical office buildings have a nice cash coupon, and now you can leverage it and raise positive cash flow, and so that you can get a return up at 8-9%. We're not going to be reaching for double digits when rates are so low. That lowers all the returns, but it does provide opportunities. Look at 2010 to 2019. There were a lot of opportunities for double-digit returns or strong returns, I'll say.
Chris, we always really appreciate your level head, you charting us through the close, and of course your fashion sense, keeping it green, and also we like your button as always. Chris Ailman, it's been a joy to have you with us on this close of the election, Chief Investment Officer at CalSTRS. More coverage coming up next on Bloomberg Markets to Close. It's election day in the US, of course. Stick with us. This is Bloomberg. Well, that was it. The market has closed on election day.
Is that it? We know the results?
No, not yet, unfortunately. We're going to be bracing ourselves for maybe hours, maybe days, maybe a month for that. But for now, the market was excited about today. It was built up. There was real risk on moon, wasn't there, Romaine? I mean, up almost 2% across the board.
Yeah, I mean, look, we've been talking about there was a reflation trade creeping back into the market. We actually saw shades of it all the way back in September. It appears to be sort of taking hold here, at least in the short term, over the last couple of days. I guess the big question here, Taylor and Caroline, is whether or not it actually lasts once we find out the results of today's election.
Well, and the financials really trying to outperform today. The problem problem is they've been pretty unloved in the last few months, and so they've been really trying to dig a hole out of what has been some big underperformance. We do that in the next chart here that I'm showing relative to the 10-year yield, which has fallen, then of course been range bound. The S&P financial index on a price to book ratio, eking out maybe a 1.18. I mean, historically on a valuation, that is pretty cheap. This is interesting, as you guys know. Banks really have been under pressure. In part, they've taken about $4 billion in penalties just weeks before the election.
That's a value investor's dream chart there, right?
I could do, standard deviation. We could do price to book. I could do this all day long.
Did you know she has a CFA? Did anyone know she has a CFA?
She's never mentioned that.
Let's bring Linon Nguyen, who has been covering the financials for us. And Linon, you had a great story today talking about $4 billion in penalties that these banks have paid right up before the election. Is the timing curious?
Hi, Taylor. Yes, the timing, I think, maybe is not that curious. You see that the banks are kind of trying to hedge, I guess, against a potential Biden election victory. If they've got any enforcement issues that are live right now, it seems like there's been a bit of a rush to close them out, take the hit and take the big fines before change in regime. Obviously, the Democrats are seen to be tougher on Wall Street than the Republican administration. So I think that's definitely a calculation. That's what the analyst that we spoke to told me as well.
The fines are pretty big, and regulations got much stricter since 2008. But I mean, what is this in terms of once again seeing such enormous sums being paid out by the banks?
Very important question, Caroline, and I think the concern here is that some of the lessons from the financial crisis are being unlearned, and that potentially misconduct and backsliding is happening within the financial institutions. So Chris Wolf from Fitch Ratings makes that point, and he says, look, people who are committing, kind of misconduct should know that they're going to get caught. I mean, it comes out time and again. So why is this happening again? And that could potentially have ratings implications. If the banks are not governing themselves well, or if they're, slipping in these areas, then that could be an issue going forward. And one of the things that Fitch mentions is that fixing the problems can actually be 12 times more expensive than the initial fine. So there's a lot of, potential tie-up of management time and attention here at the banks if they do get these fines.
Yeah, of course, a lot of investors see that, of course, with Wells Fargo, and I guess now potentially Citi. Talk to me a little bit, Linon, about some of these ESG issues. Our last guest was bringing it up, and it seems like every big portfolio manager you talk to right now is steering their money and their clients in that direction.
Yeah, that's interesting, Romaine. All of the investors are now much more aware of ESG, as are the public and regulators. And so the experts I spoke to said that they don't think the administration has as much to do with the fines as the kind of general public climate and awareness of governance issues. So, if we look back, the SEC got record fines in the last fiscal year, and they also did record payouts to whistleblowers. So regardless of the regime, I think the public and the attention and scrutiny around misconduct is much higher these days, and it maybe doesn't matter whether a Republican or a Democrat is in the presidential seat, because people in general and investors in general are really intolerant of misconduct.
But what about potential regulation? Are we over that, or could we see more coming if there is, for example, a blue sweep?
Well, I think there has already been so much regulation implemented after 2008. There was a bit of a regulatory bonanza. All of the banks really beefed up their regulation and compliance departments. But again, these lapses occurred even after that bonanza. So the question will be whether the new administration or the current administration decides to beef up on regulation, given that we've seen some, fines that really, at this stage shouldn't be happening, given all of that regulation that's already been put in place.
Nanan, I almost feel numb to bank fines in some way, and I'm sure you do too. How do you think these lenders, these businesses, have actually fared the sort of fallout in terms of public relations? Have they managed these crises well? Have they managed these fines well?
Well, I think they're certainly much more aware of the optics now than they were in 2008. And to be fair, the fines after 2008 were much bigger than what we're seeing now. So I don't want to take it out of context, but I do think that banks are much more careful to manage their image, to make the right noises, to show contrition after any of these instances of wrongdoing. So I do think that they're better at managing the optics, but the question will be whether they have done enough to root out misconduct. And right now, given the level of these fines, I think there are some experts out there who are starting to get concerned.
All right, Linan, always great to get your thoughts on this type of stuff. Linan Nguyen, of course, covers all things finance for us here at Bloomberg. All right, let's get over now to Mark Crumpton, who's standing by with the Bloomberg First Word News. Mark?
Romaine, thank you. An anxious nation awaits the outcome of today's vote in the 2020 U.S. presidential election. Both President Trump and his Democratic challenger, Joe Biden, sounded confident as Americans headed to the polls. Mr. Biden made a stop in his boyhood hometown, Scranton, Pennsylvania, while the president paid a visit to his campaign headquarters in Arlington, Virginia.
I said when I announced I wanted to restore the soul of the country, but I wasn't being melodramatic. All I meant was restore basic decency and honor to the White House.
No, I'm not thinking about concession speech or acceptance speech yet. Hopefully, we'll be only doing one of those two. And you know, winning is easy. Losing is never easy. Not for me, it's not. But I think we have, when you see rallies, the likes of which in the history of this country, probably in the history of the world, nobody's ever seen before. There's a tremendous love going on in this country, and there's really a tremendous unity.
And be sure to tune in tonight for our special election coverage beginning at 7 p.m. New York time, right here on Bloomberg Television. A federal judge has ordered the U.S. Postal Service to immediately sweep facilities in several crucial swing states to find any undelivered mail-in ballots and send them promptly to election officials. On-time delivery has taken on a new urgency amid a surge in the use of mail-in ballots during the pandemic and Republican efforts to block the counting of ballots that arrive after Election Day. In the UK, officials have raised the terrorist threat level to severe, meaning an attack in the UK is highly likely. Officials say the step was taken as a precaution and was not based on a specific plot against Britain. Police say deadly incidents in France and Austria in recent weeks prompted the move. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Almost 100 million have voted so far. 100 million voted already. And more are going to vote today.
A vote for Biden is a vote to eradicate your auto industry.
My message is simple. The power to change the country is in your hands. Tomorrow, we can put an end to a president who has fanned the flames of hate all across this country.
I'm running against a very sleepy guy. We can't let the sleepy guy fool us, though, because he happens to be a corrupt politician.
It's time for Donald Trump to pack his bags and go home.
This election comes down to a very simple choice. Do you want to be ruled by the corrupt and selfless political maniacs that you're dealing with, or do you want to be ruled by the American people?
All right, we've had months and months of that. Today is election day here in the U.S., but even before today, you had almost 100 million people cast their ballots either through absentee or through early voting. Starting at about 7 p.m. Eastern time here in the U.S., you're going to start to get results from states like Georgia, Indiana, Kentucky, South Carolina. 8 p.m. is when we start to get some of those key swing states, particularly Pennsylvania and Florida. Florida, of course, the third most populous state and holds 29 electoral votes. And of course, as we know from past elections, it remains always one of the most pivotal states for presidential elections. Joining us now to talk about what's going on in Florida is our Miami Bureau Chief, Jonathan Levin. Jonathan, is Florida going to mess this up? What's going on?
Gosh, you know, we don't know, but as we look out there right now, it's eerily quiet. For a state like Florida, which time and time again finds itself in the middle of some national electoral crisis, there's just not much to say on a lovely autumn day here in South Florida.
What there is to say is what's already been done, the people who've already voted, what the turnout may particularly feel like, and how early we could get some sort of call from the state. What are you bracing yourself for?
Sure. Well, just like you said, Florida is a key example of this massive vote by mail. Florida is a state that has had a vote by mail apparatus in place for quite some time. They're actually pretty good at this. It's not one of these states where they need to wait until the last minute to get going. So we do have the expectation that, except for those ballots that came in at the very end, when we start to get results, we're likely going to see the number of votes skyrocket very early on.
Jonathan, I am curious. During the pandemic, everyone fled New York City and moved down where it was warmer. Some relocated to Florida. Have you guys done any analysis on what some of the geographic moves that we've seen during this pandemic, if they're still registering now down in Florida, what impact they may have now as we've really seen a big upend in where our population is located?
Yeah, that's absolutely true. I mean, the thing about Florida is whether it's folks moving from the Northeast or whether it's folks moving from places like Puerto Rico or Latin America, this is one of the most dynamic populations in the United States. We added something like 1.5 million voters just in the past 4 years. And so even when you think about how pollsters sample this state, it's constantly changing. And the new arrivals are coming from so many different places.
Yeah, it's interesting, Jonathan. I mean, we always talk about Florida as sort of, obviously it is one state, but it's almost like 4 states in one when you sort of break it down by some of the various regions and some of the cultures in those regions. I am curious, is there sort of a singular issue or any issue that voters in Florida at large have primarily been focused on?
I think it's probably coronavirus, because we can't forget that, this is the second oldest state in the country by percentage of the population that's 65 and older. A ton of people come here to retire. There's a large concentration of those very vulnerable long-term care centers, that's the assisted livings and the nursing homes. And, people were frightened as this thing was sweeping through Florida in June and July.
But Jonathan, people have been frightened for their prosperity, for their work as well. What industry groups have been most hit? What is business wanting to see?
Yeah, well, this is certainly a tourism state. It's not only a tourism state, but tourism is huge here. And I think one thing we got to think about is the cruise industry. We actually just today, Election Day, got an announcement from the Maine Cruise Industry Association saying that they won't be sailing again from the U.S. until the end of 2020. That's more than 100,000 jobs in the state of Florida.
One to remember that amid all the election, perhaps risk-on sentiment, COVID is still front and center, and the numbers look really worrying at the moment. Stay well, stay safe, and we wonder whether it will remain quiet for Bloomberg's Miami Bureau Chief Jonathan Levin. Great insight there. And do stay tuned, of course, 7 p.m. Eastern on Bloomberg Television and Radio. Continued coverage. Why would you want to go anywhere else for the presidential election? Now, meanwhile, let's get a quick check on the business flash headlines. Hey, guys, and Saudi Aramco won't change its third-quarter dividend, even though it didn't generate enough cash to cover the payout. Now, the world's largest oil company reported a 45% drop in profit, and it generated $12.4 billion of free cash flow. That's about 2/3 the amount it will pay out in dividends. Those dividends are an important source of cash for the Saudi government, of course, whose budget deficit is growing. Over in England, JP Morgan has joined rivals in asking the vast majority of its employees to work from home. Now, the government has imposed another lockdown, of course, starting Thursday to try to stop the spread of the coronavirus. JP Morgan has about 19,000 workers in the UK. About 12,000 of them are in London. And China has derailed the world's largest IPO. Jack Ma's Ant Group was set to raise $35 billion in a public offering in both Shanghai and Hong Kong this Thursday. Now, both listings have been put on hold. The Shanghai Exchange cited changes in the regulatory environment. Chinese regulators had warned that Ant would be subject to the same restrictions on capital and leverage as banks. Ma has called to a meeting with regulators yesterday. That's your business flash update. Taylor, I mean, we all said it. That would have been like the key story of the day if it hadn't been for the all-important U.S. elections. How are you going to be watching?
And there's a great story out. There's a $400 million payday for the bankers behind this deal. I think the likes of Citigroup and JP Morgan that sort of totally caught off guard now by sort of the lack of investment banking fees that you get. So that will be something, of course, that we watch. That is all secondary, though, because it is election day. Yeah. And we'll be watching that tonight, tomorrow, and in the days to come. And I'm
Did
sure
you know,
that
Taylor, that you can actually watch this on your Bloomberg terminal using the TLIV function or MLIV on your Bloomberg?
You and those blogs, all that humble brag, it's keeping us employed. That does it for Bloomberg Markets to Close. Stay covered. This is Bloomberg.